Hello and welcome back to the channel. Today I'm going to be talking about an unfortunate situation that we saw occur in one of our federal employee clients. And we're going to be kind of talking about this hypothetical character named Mark, right? Mark was 52 with 20 plus years of service, passed away, right? And assumed the benefits would carry over to their surviving spouse, assumed that the life insurance and the pension would be enough, right? Assume that there would be health insurance that went through. But really, in the end, it really wasn't as much as what Mark had intended for that to be. And there was a gap in coverage and gap in protection. And these are the things that we want to make sure that you avoid as a federal employee. So the first benefit that passes through is going to be the FEGLI insurance, the life insurance, right? And most federal employees are going to have a basic benefit in play, which is going to be covering 1 times their salary. Now, the allure to the FEGLI benefit is that it's tax-free to your beneficiaries, whether it's the spouse or children. It is tax-free. It's going to avoid probate, so it's going to be immediate, and really it shows up in a bank account as soon as a death certificate is in play. However, if you're only covered at the basic benefit, it's really only going to cover about 1 year's worth of income. So the next benefits are really going to be what we call the survivor benefits. And these are really intended for the spouse, right? So the first is going to be the basic employee death benefit. This is going to be a lump sum that your spouse receives, which is 50% of your final salary, plus a fixed amount, right around $35,000 today, index for inflation. That's going to give around $85,000 as a lump sum benefit. The difference with these survivor benefits, though, is they're going to be taxable. So if they're taxable, that surviving spouse is only going to receive probably around 65K of that 85 hypothetical benefit I just gave you, assuming a $100,000 salary in their pockets, right? Now, if that federal employee died while he was working actively and had 10 years plus of service, there's also going to be a survivor annuity. And that survivor annuity is going to allow 50% of that federal employee's accrued pension to pass on to their spouse. In addition to that, the federal health insurance is also going to pass on to the spouse. But if that spouse was not covered by a survivor annuity or pension, meaning that active employee didn't have 10 years of service or more, no health insurance for the surviving spouse. So that's a huge, huge planning piece that needs to be in place. You need to make sure that you're leaving your spouse with active health insurance if something happens to you. So as we kind of drift through some of the other areas, we come to the TSP. We've seen folks not having their spouse as their primary beneficiary. That's a major planning mistake because the spouse is the only person that's going to have more tax advantages than non-spouses are. Why? They have a lot better withdrawal requirements than non-spouses, meaning they're not going to be required to withdraw that an entire account in 10 years. They have their entire lifetime to withdraw that, and their required distributions will begin most likely at 75. A non-spouse beneficiary is going to have to withdraw that pretty much within 10 years, subject to those IRS rules. So not leaving your primary beneficiary as your spouse, in our opinion, is often a mistake. As we move out to other hidden TSP rules, we bump into one of the ones that we just kind of actually went through in real life, where a beneficiary of a TSP inherits that TSP. Let's say it's the spouse. Let's say the father passes away and the mother now of that second beneficiary inherits that. Now, if that second beneficiary, let's say in the mother in this case, inherits that TSP and then dies, so it was the father's TSP, then mother inherited it, and then mother now dies, there is no 10-year clock, no life expectancy stretch for that second beneficiary. We just went through an example of this. It was a major surprise to the beneficiary that inherited this, the second beneficiary, which let's call it the son. And he was really upset that his mom, when she inherited that TSP from the father, did not roll that out to an IRA, because had she had rolled that out to an IRA, therefore it would have preserved the stretch 10-year window for him inheriting that now from his mom. So again, it went from dad to mom to son. And because of that, and it was held in the TSP the whole time, the son lost the 10-year stretch clock. So that's another kind of unknown that has come about in our works with federal employees that I think we need to make sure folks are aware of. The other thing that we also have seen, right, is disability. And I think folks really don't realize that disability only from a federal perspective starts when the requirements are met by Social Security, and anything which is a pretty negligible amount that will be paid out, which is around 40% of your salary, is actually subtracted by what Social Security will pay you. So it's not like you're going to receive a lot if you become disabled as a federal employee. So I wanted to note that as well. And also wanted to touch again on those healthcare and long-term care decisions, right? FEHB coverage, it's an excellent coverage. It will pass to your spouse as long as you got that 10-year requirement for an active federal employee, or you can get away with 5 years if you're at 62. But other than that, right, you want to make sure that that spouse is covered by an active survivor pension to receive those FEHB benefits and continue the coverage. Medicare also does not supply benefits for long-term care costs. Medicare Part A will supply about 120 days of coverage, but after that, you're really going to be on your own. So this is where you need to stress test your financial plan, make sure there are enough assets to pay for those long-term care costs, because we're seeing it happen in our family with my grandmother's care. Extremely expensive and a lot of burden on the family, particularly my aunt. You're talking about $20,000 a month that is currently being costed for her care. So the real risk is that, you've got enough assets, you've got enough insurance, you assume the beneficiaries were correct, you assume that your spouse was going to have the FHB, you assume that there was going to be a stretch availability for the TSP to your beneficiary or your non-spouse beneficiary, and it wasn't there, right? These are all the assumptions, but a lot of times those are incorrect. So what we're really trying to do is help you review this stuff, make sure that you're making good decisions, confirm those beneficiaries, confirm the elections, right? Make sure that you've got asset protection in place so that it's not just about retirement income, right? If you have $2 million in your TSP today, but it turns into $1 million because we go through a recession, is that enough for all these things to happen if you aren't carrying long-term care insurance and the things that we discussed and risks we discussed today? So thanks for watching the video. Hope this resonates. Hope this was informative. We'll see you on your next video. Thank you.